When it comes to investing, most beginner investors eventually face this question. Should I invest steadily over time or wait for the perfect opportunity when the market drops? It is the classic debate between dollar cost averaging and buying the dip. In this video, we are going to break both strategies down, look at real-world scenarios, and go through what well-known studies actually show. We'll also look at the psychology behind why investors often make the wrong decision and how that usually plays out in real markets. Welcome back to Chloe Capital Brief. I am Chloe, and here we explain investing in a simple and practical way. And just as a reminder, this video is for education only, not financial advice. Let's get into it. Dollar cost averaging, also known as DCA, is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. For example, you might invest $500 on the first of every month into an index fund, whether the market is up, down, or flat. This approach removes emotion from investing. You are not trying to guess when to get in. The key idea is in the name itself, averaging when prices are high. Your $500 buys fewer shares. When prices are low, you buy more. It is not about timing the market, it is about time in the market. This approach is especially useful for people who earn a regular income and want to build wealth over time. It builds consistency, removes the pressure of trying to catch the bottom, and helps avoid the trap of never investing at all. Buying the dip takes a different approach. Instead of investing consistently, you wait for a drop in the market before putting money to work. The idea sounds simple. Buy when prices are on sale, but the problem is immediately obvious once you try to define it. What exactly is a dip? A 5% drop. A 10% drop. Something else entirely. And even if you define it, what happens if the market drops and then keeps dropping? Or what if you wait and the market rebounds without ever giving you that entry point? Buying the dip assumes you can recognize a temporary decline in real time, which is much easier to say than it is to actually do. Even professional investors struggle with this. Let's look at a simple example. Meet Alex and Jordan. Both have $6,000 to invest over 1 year. Alex uses dollar cost averaging. He invests $500 on the first of every month. Jordan decides to buy the dip. He holds his $6,000 in cash and waits for a market correction of at least 10% before investing. Now imagine the market has a weak first quarter, dropping about 8%. Jordan thinks it will go lower, so he stays in cash. Then the market gets a positive economic surprise and quickly starts recovering. The dip he was waiting for never really arrives in a clean way, and he's still holding cash. Meanwhile, Alex keeps investing month after month. When prices are lower, he buys more. When prices are higher, he buys less. By the end of the year, Alex is fully invested. Jordan is still waiting for the perfect moment. To understand how this plays out over time, let's look at a study from Charles Schwab. They tracked the performance of different investing strategies over a 20-year period from 2003 to 2022. Each investor received $2,000 per year and invested in the S&P 500 using a different method. Peter Perfect always invested at the exact market bottom every year. He ended up with more than $138,000. Ashley Action invested her $2,000 on the first trading day of each year. She ended up with about $127,000. Matthew Monthly used dollar cost averaging, spreading his $2,000 across 12 months. He ended up with more than $124,000. Rosie Rotten always invested at the worst possible time, the yearly peak. Even then, she still ended up with about $121,000. And Larry Linger, who stayed in cash waiting for the perfect moment, ended with just $44,000. What stands out is not just the difference in returns, it is how small the gap is between perfect timing and simply staying consistent, and how large the gap becomes when you are not invested at all. Now, it is important to understand this is not a simple yes or no decision. Many long-term investors still use dollar cost averaging as their core strategy, but they may also keep some cash available to take advantage of major market drops. The key difference is they are not waiting endlessly for the perfect moment. They stay invested and act when opportunities appear. The real advantage of dollar cost averaging is not just mathematical, it is psychological. It removes the need to make timing decisions, it reduces pressure, and it avoids the situation where you hesitate when the market actually moves. Buying the dip sounds easy when everything is calm, but when the market is actually falling, behavior changes very quickly. People hesitate, they wait longer than they planned, or they do nothing at all. Even Warren Buffett has pointed out that for most people, CONSISTENTLY, investing in low-cost index funds is often the most reliable approach. Because in the end, your mindset matters as much as your method. It is not just about what strategy you choose, it is about whether you actually follow it. And that is usually what separates long-term outcomes.